Welcome to Market Brief After Hours. It was a blockbuster day on Wall Street as we finally broke a stubborn 3-day losing streak. Investors managed to look past escalating geopolitical tensions in the Middle East to focus on a strong start to the corporate earnings season, alongside a massive rebound in semiconductor stocks. Let's dive straight into the numbers. How did the major U.S. indexes wrap up the session?
It was a highly encouraging session across the board. The Dow Jones Industrial Average surged by 385 points, or 0.74%, to close at 52,225. Meanwhile, the S&P 500 advanced 0.89% to finish at 7,509. And the tech-heavy Nasdaq Composite led the charge, climbing 1.29% to end the day at 25,837. This broad-based rally was a welcome relief for investors after a tense few days.
That is a significant bounce, and it seems corporate earnings played a massive role in shifting the sentiment today. We had some heavy hitters reporting.
Absolutely. The second quarter reporting cycle is off to an incredibly strong start. Out of the roughly 66 S&P 500 companies that have reported so far, nearly 88% have beaten bottom-line estimates. Today, industrial giant 3M saw its shares jump more than 7% after delivering better-than-expected earnings. General Motors also reported a solid beat on both the top and bottom lines, which lifted its stock by nearly 5%.
With big names like Alphabet, IBM, and Tesla scheduled to report later this week, the stakes feel incredibly high. What are analysts saying about the hurdles these companies face?
The consensus is that the bar is set exceptionally high this quarter. Analysts are pointing out a sharp contrast with last quarter, where geopolitical uncertainty had actually lowered expectations, and investors were just looking for reassurance. Now, after the market has run to record highs, simply posting good results might not be enough. Companies that fail to clear these elevated expectations are being punished quickly by the market.
That puts a lot of pressure on tech. Speaking of tech, we saw a massive comeback in semiconductor stocks today. What drove that sector's performance?
Semiconductors were definitely the engine of today's market. The VanEck Semiconductor ETF, or SMH, gained more than 4%, while the iShares Semiconductor ETF closed up over 5%. Looking at individual names, Micron Technology was a standout, advancing 12%, and Intel moved higher by 8%. We also saw Marvell Technology jump more than 6%, and Astera Labs add 3%. Additionally, SanDisk led the gainers in the S&P 500, closing up more than 14%, while Western Digital and Teradyne both rallied 12%.
And there was some interesting news regarding NVIDIA making a strategic move that lifted another stock, right?
Yes, Nebius Group NV led the gainers in the Nasdaq 100, closing up more than 18%. This massive jump came after a regulatory filing revealed that NVIDIA has taken a 9.3% stake in the company. It's a clear signal of continued strategic positioning within the AI infrastructure space.
Now, while the stock market was celebrating, the geopolitical backdrop remains incredibly tense. We're seeing ongoing military developments between the U.S. and Iran. How did that impact the energy markets today?
It's a highly volatile situation. U.S. Central Command carried out its 10th consecutive night of strikes on Iran after the ceasefire was declared over. In response, Tehran's forces have targeted U.S. military assets across the Middle East, and their Houthi allies have declared a maritime embargo against Saudi Arabia. This directly impacted shipping, with 2 tankers carrying Saudi crude to Asia reversing course in the Red Sea. Consequently, oil prices rose to a 5-week high, with West Texas Intermediate crude futures up 2% at $84.91 a barrel, and Brent crude also rising 2% to settle at $91.01 a dollar.
Yet, despite those high oil prices, stocks still managed to rally. Why didn't the energy spike drag the market down like it did on Monday?
The key difference today was the emergence of fresh diplomatic efforts. Reports surfaced that mediators have proposed a 10-day temporary ceasefire between the U.S. and Iran. That potential diplomatic window acted as a pressure valve, keeping oil prices from spiraling completely out of control and allowing equity investors to focus back on earnings.
That makes sense. Let's take a quick break here to hear from our sponsor. And when we return, we'll look at how international markets responded, check in on the cooling U.S. labor market, and break down some fascinating technical setups in the Forex and precious metals markets. Stay with us. Welcome back to Market Brief After Hours. Before the break, we focused on the major U.S. indexes and the energy sector. Now, let's expand our view globally. European stocks also had a firm showing today. What were the highlights there?
European markets closed higher, largely supported by technology and mining sectors.
The Pan-European Stoxx 600 rose 0.38%. Looking at specific countries, the UK's FTSE 100 climbed 0.42%, Germany's DAX gained 0.49%, and France's CAC 40 edged up 0.1%, while Switzerland's SMI moved up 0.31%. In the UK, mining stocks like Antofagasta and Fresnillo climbed 5.8% and 4.5% respectively, while major banks like Lloyds, Barclays, and HSBC gained around 2%.
We also got some surprising economic data out of Europe, particularly regarding the UK labor market and German economic sentiment.
We did. The UK unemployment rate unexpectedly held steady at 4.9% for the 3 months to May, defying expectations of a rise to 5%. Total employment actually rose by 148,000, which was well above the forecast of an 85,000 increase. Over in Germany, economic confidence strengthened significantly. The ZEW Investor Sentiment Index jumped to 26.3 in July, up from 10.5 in June, hitting its highest level in 5 months and easily beating the expected score of 18.0. However, it wasn't all positive news for Europe. Spain's trade deficit widened sharply to over 8.2 billion euros in May, driven primarily by a surge in energy imports.
And how did Asian markets fare amidst these global tensions?
It was a mixed bag in Asia. Japanese markets rallied strongly as traders returned from a long holiday weekend. The Nikkei average soared 3.26%, while the broader Topix index settled 2.44% higher, with Kyosha Holdings jumping over 17% and SoftBank surging 6% as AI concerns eased. China's Shanghai Composite jumped 1.79% following share buyback and dividend announcements from several state-owned enterprises. South Korea's KOSPI also snapped a losing streak, climbing 3.56%, led by Samsung Electronics and SK Hynix. On the downside, New Zealand's benchmark index slipped 0.29% on rate hike fears due to rising fuel costs, and India's Nifty 50 and BSE Sensex both closed slightly lower.
Back in the U.S., we also received some new labor data from the ADP Research Institute. What does that tell us about the broader economy?
The ADP data shows that the U.S. private labor market is continuing to cool. Private employers added an average of 16,500 jobs per week in the 4 weeks ending July 4th, down from the previous period's average of 19,250. This is the 4th consecutive weekly slowdown we've seen. It lines up with the broader June payroll data, which came in at 98,000 jobs, well below the market expectations of 113,000.
This cooling labor market must be weighing on the Federal Reserve's mind. How did the bond market react today?
Treasury yields edged slightly higher across the curve as investors balanced these employment figures against geopolitical risks. The yield on the benchmark 10-year U.S. Treasury note rose to 4.63%, while the policy-sensitive 2-year Treasury yield gained to 4.264%. The 30-year bond yield edged up to 5.133%. Analysts noted that the bond market remained relatively steady because those Middle East mediation reports helped cap the immediate panic over energy prices.
Let's pivot to currencies. We have some detailed technical data on major Forex pairs today. Let's start with the euro and the pound against the US dollar.
The euro continues to face downward pressure. Euro USD closed down 0.11% at 1.1402, rejecting its intraday high of 1.1429. This pair is firmly entrenched in a downtrend, trading well below its key moving averages. To give you some context, the 50-day simple moving average is at 1.1516, the 100-day is at 1.1580, and the 200-day sits at 1.1638. We see a similar bearish story for the pound. GBP USD fell 0.36% to close at 1.3382, slicing right through its 100-day moving average of 1.3401 and its 200-day moving average of 1.3399. It's now resting just above its 50-day moving average of 1.3374.
What about the euro against the pound and the dollar-yen pair?
Euro GBP saw a counter-trend rebound, closing up 0.27% at 0.8521. However, despite this daily gain, the broader trend is still heavily bearish, with the price well below its 50-day average of 0.8609 and 200-day average of 0.8683. Meanwhile, USD JPY is showing incredible bullish momentum. It surged 0.44% to close at 163.20, near the absolute high of the day. This pair is in pure price discovery mode, trading far above its 50-day moving average of 160.73 and its 200-day average of 157.47. Intraday pullbacks are being bought up very quickly.
That dollar strength is fascinating. Now, shifting to commodities, both gold and silver staged massive rallies today. What are the key technical levels there?
Gold made a powerful statement, reclaiming the $4,000 level to close at $4,085, up nearly 1.9%. This was a classic bullish engulfing candle that rejected the key $4,000 support zone. Even with this jump, though, the medium-term trend remains technically bearish, as gold is still trading under its 50-day moving average of $4,290 and its 200-day average of $4,479. Silver followed a similar pattern, surging over 4% to close at $58.75. It's a strong short-term bounce off support in the $55 to $56 range, but like gold, it remains well below its 50-day moving average of $67.80.
Let's wrap up with some individual company news that caught everyone's attention today. Elon Musk made headlines again, this time warning short sellers targeting SpaceX. What's happening there?
Yes, short interest in SpaceX has skyrocketed, now making up about 32% of its publicly tradable float, which represents roughly $25 billion in bearish bets. That is a massive jump from just 5 to 7% a month ago. Musk took to social media to warn these short sellers that they have little chance of survival. Despite the heavy shorting, SpaceX shares actually snapped a 7-session losing streak today, rising over 3% to close around $124 after Macquarie analysts reiterated an outperform rating.
And finally, what other notable stock movers did we see today?
On the positive side, Hasbro closed up more than 8% after reporting second quarter revenue of $1.14 billion, beating expectations. Robinhood Markets also gained over 7% after analysts suggested its revenue from prediction markets could soon overshadow its crypto trading revenue. On the losing side, Danaher fell more than 10% after issuing a weaker-than-expected third-quarter revenue growth forecast, and MSCI Inc. also dropped over 10% after missing adjusted earnings estimates.
It's certainly a dynamic market environment, with earnings, geopolitics, and technical levels all colliding. That's all for today's episode. If you find this useful, please follow Market Brief after hours. We'll see you next time.